Markets move with a rhythm most people never see. Headlines scream unexpected crash or sudden surge, yet behind every major market shock, there is a carefully structured sequence of events that begins long before the public ever notices. The idea that these shocks happen by chance is comforting, but it is simply untrue. Beneath the surface, layers of economic influence, financial strategy, and policy timing work in unison, setting the stage for what appears spontaneous but is anything but. To understand why market shocks strike at moments that feel perfect or perfectly inconvenient, you must first step back in time. Financial systems, as we know them today, are built upon centuries of experimentation, trial, and careful orchestration. The earliest organized banking practices emerged not only to safeguard wealth, but also to create mechanisms that could anticipate and influence economic behavior. Wealth accumulation, interest management, and the development of lending networks were all designed to ensure that resources could flow predictably, even in times of uncertainty. Key figures in finance from the 17th and 18th centuries, often operating quietly behind governments and monarchies, realized a fundamental truth: control over credit, access to information, and the ability to coordinate multiple markets could move economies on a scale few imagined. A decision made in one city how much to lend, when to call in debts, or which commodities to acquire would ripple outward, influencing prices and confidence far beyond the initial transaction. These were early lessons in what would become a pattern repeated throughout financial history. Small, precise movements in one place could lead to massive, delayed consequences elsewhere. The rise of stock exchanges and centralized financial markets accelerated this dynamic. By the 19th century, information could travel faster, but not fast enough for the average investor to fully grasp the full picture. Those with early access to economic indicators, interest rate changes, commodity supply reports, or large-scale trades could act days or even weeks before broader markets adjusted. This gap between insider understanding and public awareness created an environment where shocks could appear sudden, yet they were carefully timed results of invisible planning. Technological advances, particularly telegraphs, the telephone, and later electronic communications, made this process even more potent. Financial actors learned to coordinate not only across cities but across continents. Patterns of liquidity, credit tightening, and market positioning began to follow predictable cycles, even as they appeared random to the outside observer. Every crash, correction, or surge was preceded by subtle signals: shifts in bond yields, currency fluctuations, or slight variations in commodity availability. The public often missed these signals entirely, perceiving the resulting event as a surprise. The psychology of markets also plays a crucial role. Human behavior is predictable in ways that financial architects have studied for centuries. Confidence rises and falls, not purely based on hard data, but on perception, sentiment, and timing. Strategic moves such as adjusting interest rates or releasing economic reports at specific moments amplify the effect. By aligning technical financial preparation with behavioral psychology, those with foresight could create conditions where markets responded almost automatically. Even during periods of apparent stability, these forces operate quietly in the background. Large-scale investors, governments, and central banks monitor multiple streams of information, calibrating their moves to maintain balance, protect assets, or influence outcomes. They understand that an untimely adjustment can create volatility, while a well-timed move can reinforce control over a system that to most people seems unpredictable. The market shock itself is often the final visible link in a chain of adjustments invisible to the general public. History is full of examples. Consider the Panic of 1907, the Great Depression of 1929, or the oil crises of the 1970s. Each shock appears abrupt, yet careful examination reveals layers of preceding action: shifts in credit, stockpiling, subtle policy changes, and behavioral nudges that prepared the market long before any headlines appeared. Those who had access to these patterns could anticipate outcomes, while the average individual experienced chaos as if it emerged from nowhere. By understanding this framework, a critical truth emerges: markets are not chaotic by accident. They are guided by a hidden architecture, a network of decisions and timing that ensures shocks occur in ways that serve broader financial strategies. The appearance of unpredictability is real for most participants, but it masks a deeper order designed by those with knowledge, foresight, and the ability to act across multiple domains simultaneously. The very forces that make markets efficient for insiders create tension for the public. When these forces align perfectly, a shock can move with precision, affecting confidence, investment, and liquidity in a synchronized fashion. It is this orchestration, careful, deliberate, yet invisible, that explains why market shocks always seem to arrive at the perfect moment, and why they often feel so devastating to those who are unprepared. The subtle orchestration that guides markets does not stop once a shock occurs. It only evolves. After an initial disruption, the interplay between liquidity, credit, and public perception becomes even more critical. Markets are not merely reacting, they are being guided, almost invisibly, by systems designed to respond to stress in ways that protect the larger financial framework while also creating opportunities for those who understand the underlying patterns. One of the most revealing aspects of these dynamics is how timing shapes outcomes. Central banks, governments, and major investment institutions rarely act in isolation. Their moves are coordinated with broader market rhythms, economic calendars, and even global news cycles. When financial actors release information or adjust policies, it is rarely by coincidence. A rate change, a subtle statement about inflation, or a shift in reserve requirements may appear minor, but it is part of a chain reaction that nudges behavior across entire sectors. Markets respond first to the few who have the information, then to those who interpret trends correctly, and finally to the broader public. This sequential response creates waves of movement that amplify the impact of a single action. In effect, a market shock is not a single event, it is a process. Each step is carefully calculated, each ripple planned, and the public sees only the culmination. This is why seemingly unexpected drops or surges often have indicators that only a trained observer could detect. The modern era has magnified these dynamics. High-frequency trading, instantaneous global communications, and massive interconnected financial systems have accelerated the chain reactions. A single trade in one major market can trigger automated responses across dozens of exchanges within seconds. Algorithms designed to detect patterns invisible to humans now participate in the orchestration. They respond to price movements, news sentiment, and volatility signals in ways that often mirror the intentions of larger institutional strategies. The result is a system where a market shock can unfold with near-perfect timing, even across continents. Historical parallels reinforce this understanding. Consider the financial crises of the 2000s. Subprime lending, securitized mortgage markets, and global investment flows created conditions where shocks were inevitable. Yet the timing of the collapse of major financial institutions was not random. It followed a predictable chain reaction rooted in leverage, liquidity mismatches, and interdependencies that had been building for years. Analysts who studied the indicators could anticipate pressure points, but for the average investor, the event appeared sudden, almost miraculous in its coordination. The psychology of the market amplifies the effect. Confidence and fear propagate through social, media, and institutional channels. Public reaction often lags behind insider understanding, and this lag is exploited not maliciously, but strategically by actors seeking to manage exposure, allocate resources, or stabilize systems. The public sees a sudden crash, while the underlying forces have been in motion for months, sometimes years. The perfect moment is not a coincidence. It is the convergence of planning, timing, and human psychology. Even after a shock, the system adapts. Stabilization measures, emergency interventions, and regulatory responses are not random reactions, they are part of the ongoing orchestration. Liquidity injections, market reopenings, and communication strategies are timed to restore confidence, prevent panic, and guide public behavior back toward equilibrium. Each adjustment itself generates subtle chain reactions that influence future expectations and behavior. Those who understand the patterns can anticipate not only shocks but also the recovery phases. Modern data illustrates this with unprecedented clarity. Global capital flows, interest rate adjustments, and real-time trading data reveal that market shifts often precede public knowledge by days, weeks, or even months. These invisible patterns demonstrate that while markets may appear chaotic to the uninformed, they are governed by a deeper structure of influence, timing, and decision-making. The mechanisms that create these shocks operate continuously, constantly recalibrating to maintain the broader system's stability while also allowing selective opportunities for those who navigate it skillfully. Ultimately, the lesson is clear. market shocks are not random. They are the product of a multi-layered system where timing, information, and human behavior intersect. The public witnesses the end result: a sudden crash, a sharp rise, or an unexpected correction, but the real action has been quietly unfolding behind the scenes. Understanding these dynamics is not only about predicting outcomes, it is about recognizing the patterns that shape economies, influence wealth distribution, and govern financial stability across generations. As the invisible forces orchestrate each movement, the modern landscape adds new complexity. Globalization has intertwined markets more tightly than ever, and technological advancement ensures that reactions happen at lightning speed. Information travels instantly, decisions are executed automatically, and patterns that once unfolded over months now play out within hours. Yet even in this hyper-connected environment, the underlying principles remain consistent. Timing, coordination, and human psychology converge to produce outcomes that seem sudden, but are in reality the culmination of long-prepared dynamics. This continuity is crucial to understanding why some investors, institutions, and even nations can navigate crises with comparative ease, while others are caught off guard. Those with insight into the hidden structures of markets, who track liquidity flows, anticipate policy adjustments, and interpret subtle signals, can position themselves advantageously. Meanwhile, the general public experiences the aftermath, reacting to events that were quietly set in motion long before headlines appeared. The data tells a compelling story. Historical analysis of major financial events, from the Great Depression to the 2008 global financial crisis, reveals repeating sequences. Asset bubbles inflate, leverage expands, regulatory gaps widen, and public confidence builds on fragile foundations. In every case, early movers and informed actors adjust in anticipation, while most of the population only recognizes the danger once it has become undeniable. The perfect moment is therefore not merely a coincidence. It is the precise intersection of systemic pressure, human psychology, and strategic timing. Consider modern parallels. Central banks use predictive modeling to gauge risk and influence behavior, often announcing minor adjustments or signaling intentions long before implementing major changes. International institutions coordinate to stabilize global liquidity and manage cross-border financial exposure. High-frequency trading algorithms execute decisions based on patterns invisible to human observers, amplifying the speed and impact of movements. Even news cycles are subtly influenced, as timing of announcements affects market sentiment in ways designed to stabilize or guide responses. Each component interacts with the others, creating a complex web where shocks are inevitable but controlled in their delivery. Yet this system is not infallible. Unexpected interactions, external shocks, and unpredicted human behavior can amplify volatility, producing consequences that exceed even the most calculated forecasts. The interplay between calculated control and unpredictability is what makes financial systems simultaneously robust and fragile. Every market shock teaches a lesson: that stability is built on foresight, coordination, and a deep understanding of underlying patterns, rather than on randomness or luck. For anyone seeking to comprehend markets, three key takeaways emerge. First, market shocks are predictable in principle, though not always in precise timing. Understanding the structural patterns, the flows of capital, the role of leverage, the influence of sentiment is essential to anticipating potential crises. Those who study these forces can recognize warning signs and position themselves wisely. Second, public perception often lags behind reality. Most people see only the outcome, not the invisible processes that led there. Awareness of how markets operate beneath the surface allows one to distinguish between panic-driven reactions and informed, strategic responses. Third, timing is everything. Market outcomes are rarely random. They occur when conditions align, creating a window where reactions, opportunity, and risk converge. Mastery of timing, whether in investing, policy, or financial planning, is as critical as understanding fundamentals. The warning is clear. While knowledge of these mechanisms provides an advantage, markets remain influenced by factors beyond any one individual's control. No strategy can eliminate risk entirely, but comprehension of these invisible structures can mitigate surprises and guide decisions in ways that are informed, deliberate, and measured. In conclusion, markets do not move by chance. They are guided by a complex interplay of information, timing, psychology, and strategic decision-making. Headlines may surprise the public, But the forces shaping these events are neither random nor unseen by those who know where to look. By recognizing patterns, tracking flows, and understanding timing, one gains insight into a system that governs wealth, stability, and opportunity on a global scale. As you reflect on these lessons, consider the subtle ways markets are influenced around you daily. Watch, learn, and develop the awareness that allows you to navigate financial systems with intelligence, patience, and strategy. Because in a world where timing is everything and chaos appears sudden, understanding the hidden rhythms of markets may be the single greatest tool in safeguarding your financial future.